Let's go ahead and talk about how profit is made. Okay. The story starts from sales revenue. So for example, look at this mobile phone. This is my mobile phone, right? In Dubai, this phone, the market price for this, the selling price for this phone is 4,500 dirhams. So if I am a phone seller, if I sell one phone, I get 4,500 dirhams straight away. That's my sales revenue, which is also the selling price if I sell only one phone. But the moment I sell second phone, my sales revenue climbs up to 9,000 dirhams. And then if I sell the third phone, my sales revenue goes up to 13,500 dirhams. So now this means that sales revenue is the selling price times the number of phones that we are selling. So if I manage to sell 10 phones, my sales revenue would be 45,000 dirhams. This is my sales revenue. But sometimes you don't get the amount straight away. Sometimes your customers come and they use credit cards or they go for the installment plans, which means that your customers will pay you on a later date. We also record it as sales revenue, but we call it credit sales revenue. So here we come to know that there are two types of sales revenue: cash sales, that the customer pays cash, and credit sales revenue, when the customer agrees to pay you on a later date. So now we are in a position to define sales revenue as money received or to be received. It's not always money received, and it's not always to be received. It can be total cash, it can be total credit, or it can be the combination. So money received or to be received from the sale of goods, number one. It can be cash or it can be non-cash. The next thing that we need to understand is cost. Basically, first of all, we need to pay for the goods that we sell, the purchase price of the goods. We can pay by cash, or we can ask our suppliers for a credit, which means that we will pay at a later date. Okay, what's the next type of the cost? Our day-to-day expenses. We have to pay rent, electricity, wages, salaries, you can say. The third type of cost is when we buy non-current assets, which means that when we buy furniture, when we buy buses, the things that we have to use for a longer time period, more than 1 year, 5 years, 10 years, 25 years, 20 years. So these are all our costs. The profit is made when our sales revenue is bigger than the costs. In short, when sales revenue exceeds the cost, profit is made. Profit is when sales revenue exceeds the cost. If sales revenue is equal to the cost, this means we have just covered our cost. There is no profit, there is no loss. We call it break-even point. Now the question is why profit is important for a private sector business. Okay, now we know what is profit. Profit is sales revenue exceeding the costs. The question is, what is the meaning of private sector businesses? All the businesses that are not owned or controlled by the government, we call them private sector businesses because they are owned by private people, individuals. The main purpose of the private sector businesses are profits, and they are funded by their profits. There is no government to give them support in the sense that there are no government fundings usually. Now we will see why profit is important. The first point is, number one, to reward the existing owners. Owners are the investors. They invest money. They want to get the reward, which is the profit, right? So we want to reward our owners. Why do we want to reward our owners, and how is this beneficial for the business? When we reward our owners, investors, they will keep their investments in the business. They will not withdraw their investments. So imagine if they don't withdraw their investments, if they are happy by the rewards, by the part of the profits that we are giving them, this means that the cash will stay in the business. And you know how important cash is for the business. We have already studied in the chapter, in the chapter number 22, the cash flows. So if the cash is there, it means a very good liquidity position and the business can survive. But imagine if they withdraw their investment, there will be a huge cash outflow. There will be a risk of running out of cash, and there will be a question mark on the business survival. Second point is, profit is important because if we are profitable, we can attract more investment. How? We can show that we are profitable to the investors. Investors are always looking for the profits. we can do is we can attract, we can convince the investors. This will help in growth. We can expand our business. The last point is obviously we have to pay our expenses. We cannot pay all the business expenses from our pocket or from the investment. Profit is very important because it helps to pay for the expenses. Now the point, there can be a question here. You might ask me, sir, we studied in chapter 22 that we use cash to pay the expenses. Now you are saying that profit is used to pay the expenses. Well, profit, we wait, sometimes profit is cash, and sometimes we have to wait for the profit to convert into cash, and from that cash, we pay our expenses. But that's for sure, cash is not always similar to profit. Usually it's different. So in short, profit is used to pay for the expenses, and sometimes we have to wait for the profit to convert into cash. Just like we discussed, some customers that don't pay, we wait for them to pay. Once they pay, then we use the cash to pay expenses. Expenses are, we know that, and you know better than me, salaries, utilities, rent, etc. To sum up, profit is important to reward the owners, to attract investment, to pay for the expenses. Okay, now we will talk about the difference between cash and profit. Cash and profit, they are totally different terms, but there's a huge misconception that people think that cash is profit and profit is cash, but in reality, it's not the issue. Let's see how cash is different from profit. First of all, remember from chapter 22, the cash flows. Remember, how did we calculate the cash balance, the closing one, by cash inflow minus cash outflow? That's our cash, right? But when we calculate the profit, it has a totally different formula. It's the sales revenue minus the sales expenses. These are very different terms, though there are some similarities, for example, between cash inflow and sales revenue, or cash outflow and revenue expense. But overall, they are different terms. Let's see how. First, we will analyze cash inflow. What are cash inflow? Now, you know what is a cash inflow. Cash inflow is cash coming from any source, like cash coming from sales of goods, from selling non-current assets, from receiving loans, from donations, from grants. So every kind of cash will be included in the cash inflow. But remember, cash inflow will never include the credit sales revenue, which is always included in the sales revenue figure. This is how these two figures are different. Now, let's see what comes in sales revenue. In sales revenue, there is cash from sale of goods. See, this is the point of similarity. In sales revenue, we record cash from the sales of goods. Also, the same thing also is included in cash inflow. But sales revenue also includes the credit sales, which are never included in cash inflow, since we don't receive any cash in credit sales revenue. So the point of difference again is sales revenue doesn't include any cash from selling non-current assets, from loans, from grants. So here you will only see cash sales and credit sales, whereas all these things are recorded in cash inflow. So this is how cash inflow is very different from sales revenue, though there is one similarity, one point of similarity. Now let's talk about cash outflow and revenue expenses and how are they different. When we talk about cash outflow, recall what you learned in chapter 22, cash flows. You defined that cash outflow is the cash that we pay for anything like purchases, buying non-current assets, for example, buses, furniture, machines. When we repay loans, we pay cash. That's also cash outflow. But it will not include any purchases that we have made but we haven't paid for. In short, unpaid purchases or unpaid expenses. But let's see how is it different from revenue expenses. Okay. The revenue expense will include paid or unpaid expenses only that are day-to-day expenses. For example, salaries, wages, only the day-to-day expenses, the rent. It will never include when you pay for loans, when you buy the non-current assets like buses, like furniture, the things that you want to use for more than 1 year, or when a owner takes cash from the business. You never record these things in revenue expenses, only paid or unpaid daily expenses, right? But in cash outflow, you see everything in red is there in cash outflow. So there's a huge difference between cash outflow and revenue expenses. So for all these reasons, cash is totally different from the profit. To sum up, and to look at the points of differences, number one, the formula is totally different, right? Number two, when we talk about credit sales, credit purchases, or unpaid expenses, they are only included in profit calculation. They are never included in cash calculation. And when we talk about receipts or repayments of loans, they will only be included in cash calculation, but never in profit calculation. When we talk about payments for non-current assets, like furniture, like buildings, we also call it capital expenditure. It will only be included in cash calculation, never in profit calculation. When we talk about donations from the government or grants, sometimes government gives grants to the private sector businesses, or when a company, the private sector company, sells its shares, we receive cash. But this cash will only be included in cash calculation, never in profit calculation, never. At the end, can you explain how profit is made? Simple question, simple answer. When sales revenue exceeds the costs. Can I identify and explain 3 reasons why profit is important for a business? Yes, profit is important for survival, to attract investments and grow, and to reward the owners so that they can keep their investments in the business and the cash flow is intact and we don't run out of cash. The business liquidity is better. So we can explain it in a lot of ways. Can I identify and explain 3 differences between cash and profit? Yes, why not? Cash is different from profit because the formula is different. Cash means cash inflow minus cash outflow. Profit is sales revenues minus the revenue expenditures, all the costs, day-to-day costs. Okay. In cash, when we receive a loan, we include it in cash, but we do not include it in profit. In case of unpaid expenses, we don't include unpaid expenses in cash, but we consider them and we include unpaid expenses in the calculation of profit. And similarly, there are a lot of ways you can differentiate